Hey everybody, welcome back. We're going to start today a little bit different. What I have in front of us are 39 sectors. So I look every week, actually every day, at 39 sectors. We're going to walk through these. We're going to see where money is flowing. We're going to see what's going on in the high yield market and why that's so important. What's going on in European luxury equities and why you need to watch that. It's really important to watch that stuff. I know it doesn't sound too exciting, but there is something about it. What is going on with Spirit Airlines, why it's completely misunderstood, how to play tech stocks next week. And we need to just talk about the index levels as well. So there's a lot that's going to be packed in this video, as well as smart money, dumb money. But what I really want to focus on here to start with is just looking. We're going to zoom in on this for a second here. And I just want to focus on a couple things, because what you're starting to see, now this is your demarcation line from Saturday, and I played that out so you could see how things were moving. And what I do with these 39 sectors, I get asked this all the time. I get asked, how do you utilize this data? Yeah, it's cool. But let's just say that we started here for a minute, right? You go all the way back and you just say, okay, well, where were we on Friday? Well, this is really where you were on Friday. So you can see where the money is flowing. Now, here's the SPY, and that's the candlesticks that are in here. And for our purposes, we're just going to pop that into a line real quick. But where's money flowing? Into energy. Well, that's interesting. Where else is it going? Into the crypto names after they've gotten completely beaten down. But where is it not going, right? We're not seeing the big sectors that we just saw that had huge moves. So if you start going through these, you're not really seeing it in the stocks anymore. As a matter of fact, on Friday, the stocks and cloud are all the way down here. You can't even see them with my cool logo. So what is this telling us? Well, this is telling us that we're seeing a shift on Friday in money. But where are we also seeing that shift on the tech side? Well, XLC is breaking out. XLF, utilities. So we're getting a little defensive on Friday, aren't we? Going into what? Probably the hugest earnings quarter that we have out there. So what do we have next week? We have probably the hugest earning quarter of the year, because people have these expectations. Like, is this going to last? Is it a fad? Is it not? Microsoft, Apple, all these companies coming out. But what are we seeing here? We're starting to see the energy names kick in, right? So XLE, that's your major energy sector. XOP, that's going to be your production. And then you get into like the smaller sectors right here, OIH, right? Your rig, those kinds of names. XME, you're starting to get into what? You're starting to get into your gold miners. Like this is something to watch. But what we can do with it is now you just kind of come back, and what you're looking for is just different time periods, just get snapshots. Or you go to the 23rd, and what's happening? Energy's up here. They're still playing the pot stocks, crypto. So again, what are we seeing in here? We're not really seeing the names that we're talking about a lot, are we? We're not really seeing cloud. I mean, you come down here and here's cloud again. We keep waiting, or I was waiting for software to really take off. Is that what's happening? No, it's not what's happening. And then, so when you start just playing with this just a little bit, you can start, and you go back a little bit, you could start seeing how these things start to shift. And that's how I use this data. I find it very helpful to just take snapshots of this data, just kind of scroll around with it over different periods of time. And then you can just kind of see, okay, well, where's the money flow going and where's it not going? And then, of course, you can just always change the time frame on it and go, okay, well, here's 15 out. And let's go take a look at January, and just pull right back here to that beginning of the year. And what do you have in here? Well, if somebody told you that it was going to be XLC, the pot names, telecom. So if someone told you buy Verizon, buy AT&T, and buy T-Mobile this year, you'd have said you're out of your mind. But what this does is it shows you where money's flowing, right? And you want to go where that is. Energy flows where attention goes, all of that. All right. So then you have IGV. I have it in here twice because I'm not great with organization, and I can take one out. But you also have commodities up. So if someone was going to tell you by the beginning of the year, where do you have to put money? You'd be like, oh, semis. Well, semis on the year are not even outperforming the Qs. So when we take a look at what's really going on out there, right now, this is important because we have the SPY, and that's outperforming financials. So this is 39 different sectors that I use. I want to show you something else in a moment here. I have people that are starting to follow me on TradingView. For those that are newer to this channel, welcome. Make sure you click the link in the description, or I'll pin it in the comments just to get the free newsletter that comes out daily. The reason I'm showing this is people are starting to follow me on TradingView. And if there's a way for me to share this with people on TradingView, please let me know. I don't have it set up as a script. I just have it set up as an indicator. I have this indicator created. And I have other sectors that I've got created as well, and watch lists. I don't mind sharing that stuff at all, but if someone could just reach out to me, either email or in the comments below, and tell me how to do that, that would be great. I just don't have time to try to figure it out. Anyway, so you look at these 39 sectors here, and you look at the beginning of the year. If someone told you that this is where you need to be, this FDN is internet, by the way, and this is tech. This is your Dell, your IBM. And again, I've talked to people that are even in our community that were telling me, you need to look at IBM, you need to look at IBM. And then you look at IBM and Dell. And if someone's going to say, well, IBM and Dell are going to absolutely crush the semiconductors this year, you'd be like, how is that possible? Now you have your SMCI, you have those names, you have NVIDIA, you have those moves, and we're going to get into that and what's going on there and how to prep for next week, especially with what's coming on Monday. You're going to need to watch this. But if we take a look at this, this can save us a lot of time. Now let's say, okay, well, this is too much. I don't want to go through all these different sectors. And I also appreciate your comments about not worrying about, is this edited? Is it not edited? And you're going to see by today's video, I'm able to pack in a lot more by doing it this way. But I have a 20 that I have set up where I have 20 major sectors here where I'll click on and they'll point out in a group of 20. And then if I just want to do the major sectors, and you really have about 11 major sectors, right? So if I just want to do the major sectors and go, okay, well, just show me where the money's going. And then after I have the money and I can figure out where it's going from there, then from there, what I can do, let's get rid of that, take that off. And then what I can do from there, we'll get rid of our line and we'll just drop this into, let's just drop it into a 5 and we'll go all the way back to, let's go to January and go back there. And just look and go, okay, well, where's the money really going? Well, I'll tell you where I thought the money was going to go this year. And I thought we were going to see REITs go up. Now, why aren't REITs moving? Well, we know REITs aren't moving for one specific reason. Rates aren't moving. So do we want to play with this or not? Well, this is where it gets interesting because if you watch the rest of this, where I start getting into the high yield and what's going on to the luxury market, you're going to want to look at REITs. And I'll explain why. But XBI, okay, why is that down? KRE, why is that down? So we went into this year, and what were we thinking was going to happen? Well, we thought interest rates were going to drop, right? Some people were predicting 6 cuts, 3 cuts. I personally thought things were getting so bad that they were going to cut by January. But this is where it all ties together, because then you have to start looking at it and going, well, what the heck's going on with Louis Vuitton? And why does he keep bringing up Louis Vuitton? There's a reason for it, right? There's a reason. We're going to get into that. And it also ties to the high yield market. We're going to get there. But it's important to get this concept, because if you take a step back and say, these are my thoughts, right? And this is what I think is going to happen. Well, the market doesn't really care what I think is going to happen. The market's going to do what the market's going to do, right? So expectations, and this is actually a concept called reflexivity, but you can actually read about that in a book called The Alchemy of Finance by Soros. But it's actually, this is what we thought was going to happen, and we were wrong. This is not really where the money's going. Now, I think that's going to change. But there I go again, thinking. So right now, I'm just going to worry about what's actually happening. And what's happening here? What's happening when you look at this on a 5-minute chart and you break it down to 11 sectors? Now, I know that some of these sectors are not part of the S&P, like the SOX or the cloud. They're not those XLC, XLKs, but I throw them in just so I can see what's going on. Well, what's happening with semiconductors? Well, they're getting crushed by what? They're getting crushed by XLC. Okay, so then we say, well, what's in XLC? Netflix, Meta, Google. Okay, so do we have to start looking there? It might not be the worst idea, better than a stick in your eye. And then you come here and you go, well, Microsoft, Apple. Well, what's happening next week? Earnings. Okay, so we're seeing rotation out of what since Thursday? Semis. And we're seeing rotation into tech. So you can even look at these as pair trades where people are getting out of the SOX and they're getting in the large cap. If you don't look at something like this, I don't know how you're going to be very specific on where energy is going to flow, i.e. money is going to flow, if you think about it that way. Why am I spending time on this? Because instead of you going out there and trading the same name over and over and over again, like we're all doing with NVIDIA right now, or how people were doing with NVIDIA on Thursday and Friday, if you have something like this, you're going to see a real simple way to profit from this. Now, one of the questions I always get asked in the community, and I get asked by everybody, is how do you see something like that coming? So on Thursday, and I'll get to the timestamp so you can see it. It should be somewhere in here. There it is. You can just see it right here. You could blow it up if you like and take a look at it. But what I get asked a lot is like, how do you see some of this stuff coming? And let's be really clear about it. You don't always know if it's going to work or not. You just don't. But in the community, just look at these timestamps so you can see where we're at. But what I'm watching at the end of the day is I'm watching a sector chart. And I'm watching a sector chart all the time. All the time there's a sector chart. I'm just watching where are they putting money? Because I can't move a sector. You can't move a sector. Institutions can move a sector, but we can't move a sector, right? So you have to understand where you are in the pecking order, something important to think about. But if you take a look at something like Netflix here, what I'm watching is I'm watching this at the end of the day and I'm just seeing money just pour in. You always want to look, and you might want to remember this. You want to watch the end of the day and see where money's going, right? Especially the last hour. There's a whole section in Sentiment Trader, which is a service that I'm not affiliated with or anything, but they actually chart the last hour of the day. And it's very important because that's really when institutions move. But you don't have really one green bar when it starts ripping, right? All right. So we start to see this play out. We start seeing the XLC move. People are talking about Google. So then you start sorting by sector and then you sort by stock. Sorting by sector, XLC, and then you start sorting by stock. And then you start going, where's the money going? Now you have this daily. I love charts like this, and I know you can't see it that well, but I'm just going to point it out. What you have with Netflix right here is you have a wick. And then with that wick, you're going to have to blow it up, guys. And then with that wick, you start filling in the wick. And then on top of that, you're getting all that volume. So now I have what? I have the top sector where all money is flowing, and I have the top stock in that sector. Why are you trading anything else? Right? That's how I work. I work top down. Anyway. All right. So it could have a big day tomorrow. So what I'm saying is, okay, let's start looking at that Netflix 560. Right. And then you can just see where you're at right there. And then I bought Netflix options overnight. I actually wound up selling them, making a little bit of money off the open. But we'll go from there. Now, this is where it gets important. At the end of the day, what are you doing? Right? When everybody else is sitting around, look at the buying. I'm looking at the buying, and let's blow this up. And this is just, we're talking about the earnings misses after hours and overnight 565, what's going on there. And we're just looking at Intel. I'm not going to go walk through that trading strategy right now. But what I'm looking at the end of the day is all that buying that's going on in Netflix. So I know all that buying is going on. That means the next day you're probably going to push, right? You might play games off the open. They might play games with retail, but you're going to push. And then all we're doing is following it the next morning. That's all we're doing here. I know that the dates are different. We're working. We're getting there. We're getting there slowly but surely. But then we're just watching this over and over again, right? In the video, you can see what's going on there and how you're holding that 613 level. That's been a real issue. 613.50, you might want to remember. So you can see right here already how we're already setting up. We already have a weekday. Intel was a dumpster fire. KLAC was down what, 40 overnight or 30 overnight? And, anyway, so you can see this right here and see how it's going. We're going to cover that. I'm going to cover that KLAC and how you could kind of see that there were cracks. I think it's important for us to cover that. And then we're just getting into some of these other names. But where are we going with this? This is where we're going. We already know what our target is for the day. How did we get there? By the sector chart I just showed you. Now, again, what I'm doing in the morning is I'm staying completely focused on what I want to do. So like, here we are again, Netflix. There were actually people in the room going, what do you think of Merck? And I really like Merck, but I'd buy Netflix. So I really was just trying to hammer it home that day. This is where we're going. This is the focal point. Now, why is this important? Because all that stemmed from me looking at sector charts. All of that stemmed from me looking at sector charts. You can do this too. Anybody can do this. And I would really go through this and understand what I just said there, maybe even go and watch that part again. But when you start seeing rotation throughout sectors and then you start finding the leading stocks in that sector, it can make a real big difference. Now, I use others as well, but even if you start looking at IGV, well, what's the driver between IGV? Well, maybe it's some of these hardware names, right? And so you can start playing with it that way. So I hope this was helpful. It was really important for me to get that out there so people could see it. I do want to just spend a couple minutes here going through the indexes. I don't know that I'm going to be offering a tremendous amount of value on saying, look, we're at highs. And so I don't really want to spend time just going, are we going to stay here? Or are we not going to stay here? Market crash, market go higher. It's kind of a silly game right now, right? Anyone that's looking at this chart and saying that we're just going to break down there's nothing technical about this that would say that you're going to break down, right? There's not. When we look at the world, and how I look at the world rather, is macro, fundamental, and technical. There's three parts to it. So instead of spending an inordinate amount of time on this and looking at the indexes and going from there, I felt the sector was a better utilization of our time together. And that way you could look at that and kind of go, oh, okay, well, this is how I should be utilizing this to go out and find my own ideas instead of just relying on other people, right? The whole purpose of these videos is so you can understand how my mind works, whether you like that or not. At least you can go, well, at least I know how his mind works and where he's going with it. And then you can go, all right, well, I could take that part and I could make it mine. The whole part of these videos, guys, is to give you the tools so that you can learn how to do this stuff yourself, right? Not be reliant on anybody else, okay? But this is how I view the world. Everything is, top down. So from here, here's my line, right? And that top down. And then from that spot, all I'm doing is just going, I'm going index, then I'm going sector, then I'm going stock, right? That's how my mind works. Index, sector, stock. And then in between that, there are levers that you're going to pull. Those levers are my stool. Now, this is supposed to be a bar stool, but as someone loves to point out, there's only 3 legs on it. And it is what it is. I've sat on a 3-legged stool. No, I don't have a milking stool. I've never milked anything. So I don't know what to tell you, but here it is. So here's macro, fundamental, and technical, right? That's how you want to view the world. What about the macro pictures out there right now that's bad? Okay, it's an election year. How many times does the market go down in an election year. The Kerry administration, no matter whoever's in, they always try to make it good and polish it before the election, right? It doesn't matter what side of the aisle you're on. All right. Fundamental, what do we have going on there? We have companies beating and exceeding expectations across the board in various sectors. No matter what you want to say, ISRG beat, you have other names, Netflix crushed, you have the semis and AI, which people thought was a fad, which is just silly. And then you have technical. So if you go through and you check all three of these off, okay, where are we on the macro side? Well, maybe we're not getting the 6 rate cuts that we thought. Maybe that's not the worst thing. Maybe the economy is a little more overheated than we think it is. And maybe it's a lot more resilient than we think it is. And I'm going to get to that. We're getting there. But if we check off all three of these as like little checklist, is macro really, really that bad? People are employed, people have jobs, things are super expensive because of inflation and because, we have the worst Fed in history, but we'll do that in another video. But then you look at the fundamentals. Well, the fundamentals aren't that bad. AT&T, T-Mobile, Verizon, well, they're crushing, right? You have companies that are missing. Not every company is going to do well. Not every company's run well to do well enough to stay well. All right. Technical. Can anyone look at this and tell me there's something technically wrong with that? Sure, I'm going to get someone that's going to point at some kind of wave theory that this may happen someday on a Tuesday at 12 o'clock. Okay, that and a bowl of soup gets us a bowl of soup, right? So then you start going through these like, okay, well, here's the NASDAQ. Technically, anything wrong with it? Do I need to show you 17 different indicators right now to get a read that the NASDAQ is higher? Right? It seems like an absolute waste of our time, right? Which is why we're not spending a lot of time on it. So then you start looking at the RTY and going, okay, well, what's going on there? Well, this kind of gets interesting because are those sectors going to stay down? And I don't have an answer to that yet. I do think that I own a bunch of regionals and I own a bunch of REITs and I'm not doing anything with them. But if I look at TNX, is that really the worst thing in the world? Now, if we just put the most simplest indicators on there, and I know that the date changed, and I'll get to that in one of my lives. But if I look at the 55 and the 12 and the 22, which is what I use, a 12, a 22, and a 55, right? And you look at that and go, okay, well, that's not the greatest. Let's just pop in a 200. People say don't chart yield. I'm going to save you a bunch of time. If it moves, I chart it. So if we look at that, what are we getting? All right, well, maybe we got a little goofy here. Right? And we have to look and go, okay, so we look at the technicals, we look at what's going on, we understand how to look at the sectors, we understand how to get involved in those names. Who's buying, who's not buying? This is where it gets fascinating. And what else are they buying that we don't understand? Like, why is this just sitting here? So like, watch this. This is so cool. I think it's cool. All right, so let's get rid of this for a minute, right? And I was going to cover smart money, dumb money first, but I think what we're going to do, the high yield first, because when you see this, it's just like, to me, it's mind blowing, but I'm a little bit of a nerd. So, all right, so here's high yield, here's TLT, the 20 year, right? So we bought this here when Powell came out and said, we're done raising rates. I mean, it couldn't have been clearer. And then it ran up and we made like 15 points, whatever. I'm still in the trade. I have no interest in getting out. I will literally round trip this because I personally don't think we see this again. But that's my belief. For people that were in the community at the time of it, I just said, look, easy money's made. If you want it, take it. But I plan on trying to stay with the trade because I'm not sure we ever see this again. I'm really not, unless inflation does a double dip and maybe it does, maybe it doesn't, who knows? You have the Red Sea issues, you have issues, right, that we're not going to cover here, but let's get into it. So here's high yield. Well, that looks different. What the heck is going on there? All right, so we're also in this one, right? So we're in TLT and we're in high yield. But why is high yield doing so much better? Now, let's just do something because I think it's cool. So if we go TLT and we go high yield and we look at what's going on in the market. So there's two things that are going on here. One, understand I'm not comparing apples to apples, but this is TLT, which is the 20, and here's high yield. So the average bond that's probably in here is probably, let's say, between 7 to 10 years, and here's the 20. All right, so I'm basically not really comparing apples to apples, right? But I like using TLT because people trade it. So the duration's longer. So people could say, well, you're using the end of the dragon's tail, right? Versus using a 10-year bond. True, but people trade TLT. If we look at high yield and what high yield's doing right here, and this is, where do you see these graphs? It's really kind of cool. But like, if you look at what high yield's doing here, well, people are buying high yield bonds. Okay, so why are they buying high yield bonds versus buying a US Treasury? And this is where it gets interesting. There's a spread out here. People always look at the spread between treasuries, the 10-year actually, and what high yield is getting. Well, that's getting narrower. The only time that gets narrower, really gets narrower, is when you're going through a rebound cycle. If you're going into a recession, and this is where all the people that show you this graph and cuts, and they say, oh, well, when we cut, we're definitely going into recession. Go look at February 1995. I'm not going to go through it again. But if you're in an environment, pardon my voice, I think I talked a lot this week. But if you're going into an environment, and just wrap your head around this. If you're going into an environment where they're cutting rates and you have increased productivity, you're cutting rates and you have increased productivity, Okay, there's been one time like that in 40 years where earnings are actually going up and you are in an earnings-driven rally. Whether or not you want to accept that, that's fine. But if they're cutting rates at the same time you're increasing productivity, which means earnings are going up, the only time that happened in my lifetime in 25 years of trading was 95. And it was a really good time to trade. And you get less Fed intervention, which is what we all want. We want less Fed intervention. We want stocks to actually do what they're supposed to do. All right, so what do we have here? We have high yield that's setting up to break out. We could put this into a relative chart. And then we have TLT sitting here. They're buying high yield and they're selling the long end. Well, there's only one reason to do that, because you think we're stabilization and you think we're rebounding. There's only one reason to buy high yield bonds, junk bonds. Why would you buy those? Because you think things are stabilizing, you think things are rebounding. There's no other reason to do it. So if I just do the relative graph, I'll just pop that in, pardon me, and then we'll go from here and you can see that. Okay, so what do you have here? So all we did was high yield divided by the NASDAQ. Now, if you take a look at this over time, what do you have? We have a chart that's pretty historic, right? Like this is what's supposed to happen, right? If you look from 20 on, take a look at this on a weekly, all right, and you just kind of go there and go, okay, well, if we got to 06, well, when doesn't this happen? When you're going through some kind of recessionary period, right? They'll dump high yield. But when do they buy high yield? They buy high yield when you're going through a rebound. Now, I hope you get that concept. Take a look at this. Now, to be clear about a couple things. You never know what's going to happen, and what we're doing is not predicting. What we're doing is analyzing. So this is actually a headline, and I want to just give credit to it. This is actually from Sediment Trader. High yield bonds continue to track other major recoveries. High yield bonds continue to track other major recoveries. So, and I learned this a long time ago, but when high yield gets bought, that is being bought by institutions. Why are they buying high yield? Because they think that the economy is stabilizing. Well, this is very different than what we're hearing going on out there. And I have a saying, and it's, pretty much, I think everybody has the same saying, but it's watch what they do, not what they say, right? So you have guys like Druckenmiller, they're saying, oh, we're at a 500-year asset bubble. Meanwhile, 20% of his net worth is in Microsoft and NVIDIA, right? Watch what they do, not what they say. So people can say this is bad, that's bad. They're buying high yield bonds, and this tracks major recoveries. So instead of us going into this, quote, recession that we think we're going into, what we're starting to see is quite the opposite. And that's what's important. So people always say to me in the comments, and please comment below, well, you present this data, what are you telling me? I'm not telling you anything. I'm telling you that this is the data. You do what you want with it, right? The goal is to get people to critically think here. If you're looking for something else and you want to be told what to do, it's probably not the channel for you, to be quite honest. So what I'm trying to do is get people to think kind of how I think and then take what you want from it and then kind of go from there. I mean, that's really what we're doing. But again, Sediment Trader, not my graph. And they do a really good job on some of this stuff. And they chart a lot of stuff, so I don't have to, quite frankly. Again, no affiliation with them, no link, no nothing. I just like their stuff. High yield bonds have relaxed after a December surge. Okay, well, that's fair enough. Percent, and this is data that you're not going to get anywhere else. I'll just tell you that right now. No one's out there charting the net percent of high yield bonds at a 52-week high versus a 52-week low. No one's doing this. So if you take a look at this, okay, it's going to tell you exactly. It's going to just point at 3 spots. You can see the yellow lines. I'll put my blue lines in there because it looks cool. But you get where I'm going with this. Look at the spikes. Percentage of high yield bonds at 52-week highs minus 52-week lows. Look at the spikes. What did they determine? Whether or not high yield was going to go on a run. And then you look at that and go, okay, well, when did that happen? All right, well, was this a good time to buy the stock market? Was this a good time to buy the stock market? Okay, every single one of these was a good time to buy the stock market, period. Right? Now, you only have 3, okay, and it's over 20 years. And for statistical significance, I get it. You need 30, right? Anything to be statistically significant, you need 30 data points, right? And then it will increase based upon the variables, how many more data points you need. I have 3. That's all I have. I can't give you more because I don't have more. What I could do is just say, well, look what happens when the 52-week lows are greater than the 52-week highs. Like, that's not good, right? And then when you rebound from there, it gets better. Okay. So that's what we have, and that's what we have to work with. But I want to go through a couple core things here and what this means. In December, there was a 52-week surge in high yield among bonds. Since then, we have tread water. At the peak, 33% more bonds were hitting 52-week highs than 52-week lows. So just understand that. They're not just buying the ETF. They're going out there and they're buying corporate high yield bonds. Okay. This is the second highest percentage in 20 years. Other spikes came from bear markets, blah, 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 blah. All right. Let's keep going here. iBox High Yield Index, 20% of high yield bonds at 52-week highs. And it puts little dots right there so that you can see the dots. Let me get a pointer here so that we can just make that even cleaner. Right, you can see them right here. Okay, so was this a good time to buy, right? So far from my perspective, it was a pretty darn good time to buy high yield bonds. I mean, this is probably one of the greatest times to ever go out there and buy high yield bonds, right, in history. And then how did the market do for about, 8 years? It just kind of went up like that. Okay, you did well till you had a global pandemic, and here you are now. Do you really want to bet against high yield? Do you really want to bet when this happens that you're going to go into some kind of recession? Probably not. That's probably not the smartest time to do that, right? Now, if you go here and take a look at internal momentum, okay, internal momentum by them is going to be the McClellan Summation Index. We've covered this before, the Summation Index. What I'm doing here is just showing you Summation Index, McClellan Summation Index, actually sentiment traders doing that, okay, and how it shows what's going to happen. Well, if the Summation Index pops, which it did here, and it pops here, and it pops there, after what? And this is where it gets really interesting, because there's only a couple times in history it's ever done this, right? I told you I was going to be a little bit of a nerd today. But you see how you, minus 500? All right, minus 500, minus 500, minus 500, back up. All right, minus 500 to plus 1,000. How many times has this happened? 1, 2, 3. I would actually argue it's happened, more, but I think they're going to be super technical about it. But you could actually argue that it's happened here, right? And they're just splitting hairs, and that would put you here as well, which would have been another time. You could argue that, you almost had it here, right? You can make these arguments, right? And then you can make the argument that you kind of had it here too, can't you? All right, so any of those times, still, nonetheless, not the worst time in the world to step up and get involved there, is it? Okay, so now we understand what's going on with the high yield market, and that this is a really good time to do what? To buy high yield. So if you understand that, and then you just kind of look at what this means, every time Summation Index was below 500 to above 1,000, there was one clear failure where junk bonds rolled over pretty much immediately. We don't have that kind of environment, obviously, which helps lessen the probability of seeing repeat failure. After that, it was a strong tendency to see persistent gains. This is a pretty clear chart, guys. You do not buy high yield if you're going into a recession. They would not be putting money into high yield if you're going into a recession. They just would not be doing that. I hope that's clear. So when you go back and you look at our graph, you can understand why they're buying high yield and why they're selling TLT, right? You can understand why that's happening. So TLT is probably going to go sideways to down, to bouncing around until they start cutting rates, and then it'll probably start trending back up. And then high yield is probably just going to go forward and keep getting better and better. Why? Because the underlying earnings and structure of the organizations is getting stronger. And as long as that's happening, the companies are getting stronger and earnings are better, you do not go into a recession. And what we're seeing is we're seeing signs of a rebound. So this week, Louis Vuitton earnings came out, stock rally. Let's clean all this off. Now, why is this important? This is important because it's high yield bonds, right? That's really, if you go to Louis Vuitton, those types of companies that do luxury goods, they're going to do high yield. Okay, so they're not going to go out there. They're not going to get a GE rate. They're not going to get anything like that. Hermes, those types of companies, if ELF needs money or Ulta needs money, they're going to have to go out there and they're going to go to the high yield market. That's just where they're going. They're not going to go get a Apple kind of rate, right? Now, Louis Vuitton might get a much lower rate than somebody like Ulta, but that's how you have to look at it. There's bonds ratings. We're not going to get into all of it. But what you're starting to see is if they're buying high yield, companies like this are crushing. And this is really important for people to get. If we're going into this, quote, recession and things are so bad, right? Remember, they're cutting rates. We're going into increased productivity and companies are beating earnings across the board overall if you look at them so far. And we're going into the biggest earnings week. If we take a look at this, luxury goods companies above forecast despite a slowdown in growth. The owner of Louis Vuitton, or Hennessy, blah, 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 $93 billion, up 13% on an organic basis from 23. Okay, despite a slowdown of growth, jumped more than 12% after the result of adding the equivalent of $39 billion in the company's market cap value. This is what the stock did. Okay, does this look like something that's going to tell us that we're going into a recession? Let's pull up the earnings for a second because it's red, and you can just see that they missed here to the downside by like 90 cents. Nobody cared. Why? Because they absolutely crushed it. You come here, you put the most simplest of indicators in, and you put the 12, 22, and 55, which is what I use. Drop in the 200, look where you stop. Does this mean you have to get in right away? No. What you do is you need to be aware of this and what's going on out there so that when you start looking at some of these companies, you are cognizant of what's going on. They are buying their bonds. They, who? Institutions are buying bonds of these kinds of companies. Not only are they buying bonds of these kinds of companies, okay, they're starting to look at the stocks again, right? Look at Race, look at Ferrari on Friday, and you can see how it moved. Now, from our purposes, it's hard to see these because they're on the European Stock Exchange, and I'm using proxies that trade on the OTC, just so it's easier if you guys do want to trade this. Like here's Hermes, and look what that did. Now, it's important to get this. We don't know what's going to happen, right? But they're buying high yield bonds, And the European ultra high-end luxury market is getting stronger. So let's equate that out to a couple things and start looking at some things here. And just take a look at our XLY. And we can see that our XLY, which is the consumer discretionary, is just kind of hanging in there. And now I'm going to clean this all off for a second, get rid of my drawings. And you can see the 12, the 22, the 55, and it doesn't look great, right? But you realize that Amazon is pretty much the whole market. And you can see what Amazon's doing against the high end here of that upper channel. But let's go take a look at Alta. Look at the cup, look at the handle, and look at how you're setting the break out. I don't care that you have a gap here. It's still a cup, it's still a handle. You call it what you want to call it. But look at your break here and look at how you acted. Look at Lulu. Okay. Look what happened when Lulu got to the 55 and how it's acting in here, right? Look at how this is already hitting, right? Higher lows. Okay, look at how this is setting up already, right? So when you start going through these charts and you start looking at our high end, you start looking at ELF, and you start seeing that this thing's actually back to highs. Let's get rid of my VWAPs from 23. And you start going through these charts, they don't exactly look ugly, do they? ANF. Okay? This is a stock we bought in the community, and I think we paid 72, 71 for it. Came out with earnings, and then you just see we've never even had to worry about it. No, I haven't had one concern about this trade. Not one. Okay. This is what's going on in that market. This does not happen if the consumer is weak. You have a consumer-driven economy, right? And you just keep going through the names. Now, you're going to find ones like, not all of them are going to work, like American Eagles. They're going to be like a little weaker. Maybe, they're not going to go to the sneaker company as much anymore. Maybe this got ahead of itself. You're still going to have individual issues, right? Nike, they're going to have their issues because of the growth and a whole bunch of other stuff, right? But when you start going through these names, Starbucks is this week, they're going to have companies that are going to have issues. But the guy that's buying the Frappuccino and the mobile, and Starbucks has their own issues, don't they? Like, I hate going there and then all of a sudden you're sitting there waiting while someone's doing a mobile order and you have to wait and you're there. It's actually exhausting to stop going. So they have their own issues and you're going to have organizations that have their own problems, right? But overall, what you're seeing, if you go and take a look at this, is you're seeing a pretty darn strong weekly chart here. And people are buying in the economy. And we have a consumer-driven economy. One of the easiest ways to do this is to take XLY and you divide it by XLP. And then you get rid of, let's just go to a plain chart for a second and we'll get rid of the line. And really what I referred this is, and you can do this with ETFs too, but I just like doing it with this, just because it's cleaner. And what you're really looking at here is wants versus needs, right? Because XLY, these are things that people want, and these are things that people need. Clorox, Colgate, you need toothpaste. Well, you should need toothpaste. Things like that, right? Soap, things along those lines. So when you start to see this, what happens in downtrends or in bad times in the market, people will buy what they need, not what they want. People will buy what they need, not what they want in bad times, right? When you're in good times, they will buy what they want, not what they need, okay? So when you start to look at this, you just want to start paying attention to it and going, well, they're not really, going crazy here, aren't they? Something to watch, right? Did we just pull back to a level? Is this going to change? We don't know yet. But if you are going to blow off what happened with Louis Vuitton, are you going to think that you don't need to pay attention to what's going on with Louis Vuitton's earnings? Where is the ultra high-end market and what's going on in Europe and how that links to the high-yield market, and you're going to blow that all off. It's delusional, right? You're telling yourself a story. And this is important because when you start seeing like where money is flowing, it's kind of crazy right now how money's flowing when you start taking apart what are institutions doing, right? Not only what are institutions doing, but what is retail doing? When you start tying that all together, which we're going to do through smart money, dumb money right now, it starts really putting a very different picture in your head. Now, this is something that we cover for some time. And really, this is smart money versus dumb money, but we don't refer to it as that, right? We refer to this as institutions, and we refer to this as retail. Institutions, because that's how smart money is calculated, and dumb money is retail. That is how they are calculated, and that's how it should be referred to. I go through periods of this where retail has absolutely crushed institutions and vice versa. What we're looking for is what is exactly happening, and what we're looking for is that rotation. The rotation is what we're looking for, meaning when dumb money or retail starts selling, that's usually a sign that we're at a top. When retail starts selling, that's usually when we're at a top, and that's when we just started pulling back. Well, look what retail's doing right now. And this is where it gets fascinating. We're going to drill into this a little bit. But what we're seeing is we're actually seeing, you usually get this spread right here, where the wider the spread, the bigger the issue, right? And it usually can mark bottoms or it can mark tops, right? So you should see this pretty clearly where, when smart money is completely fully invested, you're at the bottom. Where retail owns none, you're at the bottom. But it's really the breadth of the spread that is going to create the environment, right? And you can see that here where the exact opposite is happening. and the breadth of the spread is going to change this. Now, what's always interesting about this is retail can move faster than institutions, right? Speedboat can move faster than a cruise ship, right? We know that. They can turn faster. So you always see retail get out super fast, right? You see those moves down here to here, here to here, and institutions are like, oh, this is going to take a while, right? It's just the way that it is. All right. So here you have a 5-year chart, but what are you saying? You're seeing it mimic. It's actually mimicking one another. Here, take a look at this on a 3-year, and you can actually see how it's mimicking it. It's the same exact trade. So as these are actually moving, and I haven't seen this for some time, so it's kind of neat, you're actually moving in tandem. So as retail sells, institutions are selling. As retail buys, institutions are buying. So what's happening to the spread, right? This is a 1-year chart. So what's happening to the spread between these two? Nothing. Nothing's happening to the spread. We're watching these move, but if you start looking, you start to get this kind of weird pattern that starts in December where institutions and retail are trading in parity. Well, this is an awesome time to trade because if that's what's happening, then when retail's putting trades on, what's happening? Institutions are putting trades on at the same time. If institutions are putting trades on at the same time, what's happening? Retail's putting trades on at the same time. Well, now you're wondering why some of your trades are working so well. You didn't get smarter. You just have institutional money behind you at the same time because you're going into the same trades. When does this happen in the market? Okay, there is one specific time when this happens in the market where institutions and retail are usually aligned. It is an earnings-driven rally or an earnings-driven area where they're just crushing numbers, meaning that numbers are getting crushed and they're just dropping really, really fast. I'm not going to bore everyone with it, but if you go back to, let's say, 2001 and you were to chart this, you would see something very, very similar to where you were in an environment where everything was the same, but to the downside, right? If you went and looked at 99, you would see it the same way. Earnings-driven rally are going to put everybody in the same way. Why? For once, we're all looking at the same data. We're all looking at fundamental analysis and making investment decisions. This will be like this until it's not like this anymore. There's no other way to say it. Eventually, it will change. Now, what that gets us to is that gets us to just looking at a 3-month and just looking at how this changed. And you start saying, well, when did this change? Well, when did they start coming out and crushing earnings? When did companies start coming out and beating earnings? Not just SMCI and some of these other companies, but it started at the beginning of January. It really did. It started at the beginning of January. And so you start to see how these things start meshing together, right? Because you have a lot of earnings beats that are going on right now. You have a lot of private equity deals that are going on right now. So everyone's buying the same names. We're going to talk about SAVE in a second here, what's going on there and how it's completely misunderstood in my estimation, but we'll get into it. So if you're looking at this, all ships are sailing in the same direction. Now, in front of us is just the spread. So this is smart money, dumb money, or we refer to it as institutions, retail. 3 years, this is just the spread. So what I'm getting at is, look at these periods in time where you just went sideways. And you can see right here, right? And if you equate that to what happened here, we just went higher. All right, so what's happening here? We're just basically staying in line. Well, what happened? Well, we're going higher. So the spread's staying the same, even though you're here. Now, again, this is a very pessimistic level. All right, so when this even starts lifting, so you can even see this trend right here, right? Just see that trend right there? I can do it through a line so you can say it. See that spread and that trend? So what's happening there? Let's do a line instead of the arrow. It's confusing people. See what's happening? See what's happening here? And how this is starting to turn. We're starting to get aligned. We're starting to get aligned and we're seeing less divergence between what? Really important to get this. We're seeing less divergence between smart money and dumb money, and they're starting to get more and more in line with their investments. This is a great time to trade if that continues. So what we want to look for, right? See how this is narrowing? See how you had a lower low here and now you have what? A higher low? You're starting to narrow, and you've been narrowing now since September 2022. Why this is interesting is because if all these ships continue to go in the same direction, it's going to be a very strong market to trade in, up or down. If we all agree, it's going to be violent and volatile. And that's what we want because you can make money off of that, right? Because you're going to have follow through, long or short. You look at this on the 1 year and you can just see how we're just sitting there riding that line. And these lines, this is when everybody's very optimistic, specifically, when smart money is optimistic, and this is when they're pessimistic. But it doesn't matter if you're just going to go sideways because it's the spread that's actually making the move. If you drill this into a 3-month, you can really see it from January 1st on. And what's the market been doing? This is a really important concept to get. And when you start taking a look at that and you look at the 3-month and what's going on here, they're just moving in tandem. So I really wanted people to get that. I hope it was very helpful. No area have I seen more fear and greed and complete misunderstanding than SAVE. Now, is this a macro environment? Do you have a macro reason for why this is happening? Yes, you do. What is the macro event? You have a judge that has basically come out and said, this is not going to happen. We're not going to allow this. Okay, maybe that stands, maybe they appeal, maybe they don't, right? Because SAVE is supposed to be bought by JetBlue, and now JetBlue saying, maybe we're not going to do the deal. We're going to get to that in a second. And they might as well do the deal because of the breakup fee. We're going to get to that. Fundamentally, is SAVE in better shape or worse shape than it was when it started this deal? Worse shape. We're going to get to that too, and why that's actually possibly JetBlue's fault. Okay, what do we have here? We have pretty much a dumpster fire of a trade, but do we? Do we have a dumpster fire? Here's your wick, right? Is this a dumpster fire, or did we get to a point where it might just be getting washed out? Now, if you watch this channel a lot, you are fully aware that I do a lot of RSI work. And I just want to be real clear about this. I don't think this gets any more obvious that you're overdone. Now, this is going to be a news-driven event, guys, but I don't think this gets any more obvious than this. On the stock, and look at where the RSI is. To me, that's, as I like to say, or people like to say when they watch me, absolutely glaring, right? Okay, so there we are technically. Now, there's a couple things to understand. To me, this is not a technical story. It's a fundamental story, and that means it might take some time to develop. But for where this thing is trading, to me, I don't get it. So this was the news on Friday. JetBlue warns it might scrap its Spirit Airlines takeover next week after merger block. Federal judge and antitrust enforcers found the planned $3.8 billion acquisition would hurt competition. Now, this is where it gets interesting. Shares of Spirit Airlines tumbled on Friday. Warned carriers might terminate. Spirit took issue with JetBlue's warning, saying it expects JetBlue to stand by its merger agreement. Now, you have to understand this has been going on for some time. So Spirit's under the impression that they're going to merge. If they're under the impression they're going to merge, they're going to trade and they're going to act on their business a little bit differently, knowing that they're going to be assimilated into JetBlue. Right? That means they're not going to cut costs. They're not going to do things. And because of that, there's always what is called a breakup fee, because you're stopping other people from trying to acquire them, and you're stopping the organization from running the way it's supposed to be run, just the way that it is. Certain closing conditions required by the merger deal. All right. As a result, the merger agreement we might terminate January 28th. So it's coming. I expect something even to hear this weekend. Spirit believes there's no basis for terminating. Look at this language, okay? Spirit will continue to abide by its under obligations, JetBlue to do the same. Stock went to 570, court ruling that blocked concerns. Okay, so why didn't the stock drop more after JetBlue says we're going to bail on this? So on January 18th, we hit that record low, right? It actually went lower. Why didn't the stock go lower than this? Now, again, this is all fundamental. And this is, you can go get these articles yourself. Friday Spirit stock nosedive. We just went through that. Here's what's it. JetBlue evaluate its options regarding the merger deal. Evaluate its option regarding the merger deal. If the merger is terminated due to failure to obtain antitrust regulatory clearance. If the merger is terminated due to failure to obtain antitrust regulatory clearance, JetBlue would be required to pay Sprint and Sprint stockholders $400 million minus the sum of the approved prepayments previously paid to stock shareholders. Now, I don't know how much money they've already paid them. Usually these deals they pay very, very little, but that would be very interesting to find out. So what we're going to go on the assumption of is I have no idea how much they paid. Let's say that they're going to have to pay them $400 million plus 70. Let's just take a number and say they paid them 20% or 20%. So let's get rid of that 70 and say 400 million they're still owed. All right. So if the merger is terminated, failure to obtain antitrust regulatory clearance would be required to pay Spirit, I don't know where I'm getting Sprint from, 400 million, we're going to say. We're going to get rid of this because we're going to say that they've been nice and they've been giving them tens of millions of dollars the whole time. I don't think they gave them a dime, but we're just going to do that. Jets goes up, Spirit goes down. Now, why isn't it dropping more? So this is FinViz. I always get asked, well, where do you get fundamental analysis? I have no affiliation with FinViz. I get fundamental analysis from a lot of different sources. This was the cheapest one that I could find. I'm always looking for like the cheapest to show you guys. And I'm just going to show you just basic stuff here, but right here is where you're going to focus. Book value per share. Book value per share, tangible book value per share, cash. They got $1 billion in cash. What's the market cap? We're going to get to that in a second. All right. What's the book value? What's the tangible book value? Meaning if I sold everything and paid off all my debts and put a key in the door, what am I left with? And you can see you started here in 22 and where you were at 17, and you can see where you're at now. They have an issue. Let's just call it what it is. There's an issue here, right? If you go through these quarters that are up here, I believe there's 7, 8 quarters, and you go through them, you have an issue. And you can see that very, very clearly if you go back to 21. They have to do something. But you're at $12 a share right now. Right now, at speaking, you're $12 a share. Now, if you know that you're at $12 in cash value, meaning We liquidate everything. Let's say that they're wrong. Let's say that they are completely wrong and it's not $12. Let's say that they're off by 20%. It's $10 a share as of now. Let's just say they're wrong. They're absolutely wrong and it's $10 a share now, okay? All right. Here's the market cap of the company, $682 million as of Friday. They're looking at taking in $400 million if JetBlue walks away. More like 470, 480, okay? All that goes right to your bottom line. It goes literally right to your bottom line, right? It's all cash coming in, right? How long do you think it is before they take that cash in or cut some kind of deal with that fee, get that fee a year from now? And then you get into all this specific performance issues that they could sue for. There's a lot of reasons why JetBlue is going to want to cut a check and get this over with, because Spirit could literally say, I don't know why I keep calling it Sprint. Spirit could literally come out and say, we have not been doing any kind of growth or anything based upon assurances that we had, and they would be right. They would win. Okay, I'm not a lawyer, but they don't want to go through this. So based upon that and where you're at, you have $682 million here in market cap. You have a $12 book value, and they might take in another $400 million. So all you would have to do is take $500 million divided by the shares outstanding, and then you could go from there, right? So just to make it simple, let's just say that it's even less than that, and it's half of that, and you're still adding $4 to $6 to book value in cash. Stock's trading at $6. Okay, it defies logic to me. Unless Save came out and said, we're going through bankruptcy, and then people wanted to sell it, that's something different. I'm not telling you that it makes sense from a growth perspective. I'm saying at $6 a share, to me, this is absolutely ridiculous and definitely worth paying attention to for people that are looking for special situation ideas. Now, I know I start to lose people after a certain period of time because I make these videos a little bit too long, but there's a lot to go over here. So I'm going to just subscribe to the channel because I'm going to cover a lot of this Monday night. But this is really very important stuff. See where you're at up here? It's not realistic for the RSI to stay up here without working some of this off, right? So if you watched Wednesday's video, you know why we started closing some of this NVIDIA. I'm going through this for a reason because SMCI is coming out Monday night with earnings, okay? You're already seeing it build a flag. They already pre-announced great earnings, but this is not getting weaker. And I really want to touch base on this point. We wound up closing this at like 495. I actually showed like 490. I actually showed the timestamps and everything in a previous video and why we did it based upon the RSI and everything and how you could do it. That was in like Wednesday or Thursday's video. Actually, it would have been if you want to go back, go look at Wednesday's video on the 24th. I'm not going to go through it all again now for time's sake. What I want you to understand is we're not dropping. And this is the important concept. Please get this concept because I'm watching it happen. We're not dropping. We're not falling apart. And that's really very interesting to me because we're getting no pullback, and you should have had a much deeper pullback. Now, there's some levels here that you can see that are pretty glaring, like when you look at NVIDIA, and you can see how they're stepping you down, and you want to be aware of that, right? But are they stepping us down, or are they setting up a ramp? Now, what do I mean by that? Because I always get asked that. Well, what do you mean when you say these things? All right, so this is the day that we actually got out. And again, you can just go look at the timestamps on Wednesday and see it for yourself. But look at this. Look at how you're setting up here. Now watch this. See where you are here? People don't think that you should look at these Vs. You should look at these Vs. Are you starting to see a turn? Why couldn't we get lower? Why couldn't we break? Even here, I started looking at it and going, I'm probably going to buy. I actually think I bought some puts here just to see if we were going to break because you have nothing to here, right? There's literally nothing technical till you get to this level. Why aren't we breaking? Now, after hours, we did. And that was like a lot of fun the other night, right? You can see your level right here, right? So there's the real level right here. And you can see after hours, you got down there, right? So like that was a lot of fun. But what's going on? Well, you know, it's a matter of time before somebody missed earnings, right? Like not every company is going to crush in semiconductors. It's not realistic. And KLAC gave really weak guidance. Like really weak guidance. And so when you start looking at KLAC and that guidance, and then Intel, which has just been the mother of all dumpster fires, which looks like it's about ready to fall off a cliff, this is why semis went down. But this is where it gets really interesting. Look at ASML. Look at how ASML reversed. So you would expect more of a gap. Well, I expected way more of a gap fill on Friday. I didn't get it. These names are actually getting stronger going into SMCI's earnings on Monday. They had every reason to sell down, and they didn't. They're getting stronger going into SMCI's earnings. And I think that's a really important concept. Now, we're going to cover it Monday pre-market. Okay, so you're probably going to want to watch the pre-market live video because we are going to cover this pretty extensively. And then obviously we'll cover it after it happens. But this is pretty powerful, guys, because you should have had some kind of pullback after a rally like that, but they're not even letting it happen. Take a look at Lam, right? So Lam Research came all the way back even though they crushed, right? So you are saying, look at AMAT. So you are seeing them do what? They're getting out of large cap semiconductor capital equipment manufacturers, right? Where are they going? Well, I'm glad you asked. AVGO, we're seeing weakness there, right? Okay. We're seeing weakness in AVGO because they can't seem to hold. Okay. So we're not seeing it on the server side yet. But where are we seeing it? Lithography. Look at how they're responding to the stock. Why are they responding this way to the stock? Okay. Well, how about SMCI? Why are they responding that way to that stock? Why are they responding to NVIDIA that way? Right? Why did NVIDIA hold here? Right? And I think that's a really important question to ask yourself. Why is it holding? All three of those companies have one thing in common. They are not linked to the same subsector of KLAC, and all three of them absolutely crushed earnings. And that's where the money's going. The money's going into who is beating earnings and why do they think that those companies are going to continue to beat earnings. So that's one of the reasons why something like Tesla is not bouncing back right now, right? Because we're in an earnings driven rally. So it's either you perform or you're dead. It's really that simple. That's it.